Hi everyone, Shaun Humphries here. Welcome to the All Things Retirement podcast. In today's podcast, we're going to talk about some investment planning strategies for incorporated professionals who are growing assets within their corporation and they're looking to invest that money. Joining me on the call today is Thomas Holmes, CPA at Assante Private Client. You know, if you're building up money or cash within your corporation and looking to invest it, you have to be very careful how you invest that money, because if you're not careful, it can be taxed at the top tax bracket. It's very important to look for tax advantage strategies to reduce the tax bite. And Thomas is going to talk about corporate class investments as a very unique and powerful tool for reducing the tax bite on investment assets within your corporate structure. So you'll enjoy this edition of the All Things Retirement podcast. Hi everyone, Shaun Humphries here. Welcome to this edition of the All Things Retirement podcast. In this edition of the podcast, I got Thomas Holmes joining me on this particular conversation. We continue our conversation on tax planning tips for incorporated professionals and business people. So welcome, Thomas.
Thanks very much for having me, Shaun.
In the recent federal budget, of course, there was a whole raft of changes that impacted Canadians, but specifically there was one change that impacted the investment community and investors, and that was a change to the legislation around the taxation of corporate class investments. And so for the show notes on this particular podcast, we'll actually include some additional information on how corporate class investments work for investors. Many of you may not be familiar with the structure as you're listening to this podcast. In general, we know that when we have investments, those investments can generate a mix of interest income, dividend income, capital gains income. And so what's very unique about the corporate class investment structure is it allows us to take the various sources of income and create some tax advantages around them. So what I've asked Thomas to do is to unpack that a little bit for us, and I guess specifically to talk about why this structure, this corporate class investment structure, would be ideal for small business owners and incorporated professionals to use within their company.
Okay, thanks, Shaun. When we're talking about investments within the corporation, many people forget that when earning investment inside a corporation, it's actually taxed at the highest rate. So you'll be taxed the top personal rate inside that corporation. This is a big issue for business owners that are already earning substantial income. So what corporate class enables us to do is minimize distributions, taxable distributions, and eliminating interest income and foreign income. Now, taking a step back, how does this happen? When people think of a typical mutual fund or holding a bond or stock individually, whatever distribution that particular investment holds will be distributed out to the taxpayer. So if it's a bond, that'll pay out interest income. If it's a Canadian equity, it'll pay out an eligible dividend. When you hold these investments within a corporate class structure, number one, it eliminates interest income and foreign income.
Okay.
The good thing about that is interest income and foreign income are the distributions that are taxed at the least efficient rates. It also minimizes distributions. Now, the way I like to think about it is if you hold many different divisions of a single business separately, each one of those businesses are in a separate corporation and they are unable to share expenses and to share losses. If you hold them all within a corporation, you'd be able to offset losses in one division with gains in another division. The same way for corporate class structure, each of the funds are held within that corporate class structure, and that enables you to share expenses, to offset losses, and subsequently minimize taxable distributions.
Okay, so that's very powerful. So it's interesting. If I have a regular investment, let's say a stock paying dividends or a mutual fund trust that pays distributions and interest income dividends, that all of that income, typically would have to come to me as a personal taxpayer. But the other thing is within the corporation, like you said, the corporation would have dividend income, interest income, and if it stayed within the corporation and it wasn't part of their primary business activity, it could be taxed at the top tax bracket.
Absolutely.
Right? Okay, so there's a real incentive to try to find ways around that, right? You don't want those passive assets getting kicked like crazy from a tax standpoint.
Exactly. In tax, when we can't outright save tax or eliminate tax, we always try and defer. Corporate class enables you to basically minimize your taxable distributions, which goes hand in hand with having to use less of your capital to pay taxes.
Okay.
By using less of your capital to pay taxes, you keep a bigger piece of the pie on which to earn compounding returns.
So am I correct, if we look at the corporate class structure as this box, right? Within the box we have investments generating various forms of income. Could be interest, dividends, some capital gains. And then before that income is paid out, if it is paid out, what does the corporate class structure do to give you the tax advantage? You're not paying tax on those distributions. What's going on internal to that? Is it like a regular corporation where they take losses or whatever to offset that income?
It's very much like that. So
Okay.
if you hold many different funds within that same corporation, you're able to take the losses from one and offset gains from the other, or use management fees all across the different funds, and they're able to plan to use it in the most tax efficient way possible. Taking a step back to the traditional mutual fund trust or the segregated holding like a bond or a stock, you have no flexibility. Whatever that particular investment earns or distributes, that's what you're left with. And so corporate class allows a lot more flexibility, and by doing so traditionally pays out significantly lower taxable distributions, and any distributions they do pay out are eligible dividends or capital gains, which are taxed a lot more efficiently than interest income or foreign income.
So are you saying to me that I could actually have a portfolio within the corporate class structure? Let's say it's an income portfolio.
Yes.
That has maybe a higher weighting to interest payments, that kind of thing. That the first generation income would be interest income, but yet when I sell the units of that investment, it qualifies as a capital gain?
Absolutely, and I think that's what makes it even more attractive to individuals that are either approaching retirement or potentially in retirement.
Yeah, absolutely.
Who want a little bit less risk in their portfolio. They can still stay completely invested in income producing investments, but they don't have to deal with the negative tax consequences of interest income. Instead, they're left with the capital gain, which is taxed at half the rate of interest income.
So that's a very powerful strategy in a low yield environment. I mean, interest rates are at an historic low right now. If individuals can reduce that tax bite on that more conservative income generation, the corporate class structure could be really, really powerful, where you literally take conservative interest dividend income and convert it ultimately to capital gains income. So that's very powerful.
I would say that for non-registered income plans, for non-registered plans, or for money that's held in a holding company, if you're planning a significant portion of your investment to be in fixed income, then corporate class really makes a ton of sense from a tax perspective.
All the time we see T1s, and we help clients with tax returns, and they've got these carry forward. Let's say they have losses from previous investments that they carry forward, but they can't use those losses to offset interest income or dividend income on their T1s. Yeah. And yet what you're saying to me is within the corporate class structure, you can have interest, dividends, and capital gains, and they have these losses that can offset interest and dividends ultimately.
Yeah.
So that's really quite something.
Absolutely. It's rather than having this loss in a standalone investment or a mutual fund trust that you can't do anything with, the corporate class structure basically enables people to offset losses and gains to make it as tax efficient as possible.
So why aren't all investors using this strategy?
That's a great question. As a tax person, I often wonder that.
Yeah, no, exactly. Thomas, thanks so much for unpacking the corporate class structure for us today.
Okay, no problem, Shaun.
Well, that concludes this edition of the All Things Retirement podcast. I hope you found the content helpful. So again, if you're an incorporated professional, business owner, and you're accumulating retained assets or investments within the corporation, the corporate class structure could be an ideal investment option to reduce the tax bite on investment income. For more information about the corporate class structure, be sure to take a look at the show notes, where you'll have more information and PDF information that you can download. To get more information about other aspects of corporate tax planning, as well as general retirement income planning, be sure to visit the website, www.shaunhumphries.com. Feel free to contact our office at 204-977-8022 if you have additional questions. All the best as you plan for an effective retirement.